So let's fast forward. As you know, a few years ago, I started saying if you wanted to create a deflationary bust, I would do exactly what the Fed was doing. Since 2010, corporate non-financial debt has grown from $6 trillion to $9.6 trillion. Where I'm from, that's about a 60% increase. During that time, corporate earnings increased 27%. So how in the world did the S&P earnings increase 60%? It's because all that borrowed money went to finance buybacks and M&A. So this entire trillions and trillions of dollars that, to my mind, were as a result of investors being pushed by the Fed to go out on the risk curve, take more risk, resulted in a big debt built up, resulted in Donald Trump feeling comfortable doing more fiscal spending, resulted in Barack Obama saying he did not want to balance the budget on the backs of old people, so there were no entitlement cuts. So essentially, the bond market, which would traditionally have been a vigilante from all this sort of behavior, market signals were canceled. We developed yet another bubble, and we're now sort of in the position, potentially, and I want to say potentially, where we were in early '07. But I'm not calling for a cut, and that's why I say potentially. If you look at the coincident economic indicators, which I wish the Fed did, they actually look at lagging indicators. But if you look at the coincident ones, they all look quite good. GDP has a 3 handle, so forth and so on. If you look at the indicators I have historically used in my business, they're not quite red yet, but they are I'm sorry.
No, continue. They're not red yet, but what?
But they are definitely amber, and they are setting off warning signs.
What do you see?
Okay, so the best economist I know is the inside of the stock market. And I'm sure you've heard Herrick the joke, and I heard it at Bowdoin in my Economics 1 class, the stock market's predicted 9 out of the last 5 recessions. I will say with all humility, that's better than the Fed. They've gone 0 for 9, so 9 out of 5 is not that terrible. But the best economist I know out there is the inside of the stock market. So the Fed, when they look at the stock market and they look at financial indicators, probably is just looking at the S&P. But the decline in the S&P, which is funny, when I was preparing for this interview, it was 10, it's now 13, is a bit of mirage, because if you look inside the stock market, these cyclical elements of the economy, particularly the front-end cyclicals, show a completely different picture than the defensive parts of the stock market.
The stuff that's more sensitive
to the economy.
In the economy.
So, auto stocks are down 30%. They're not down 10 or 11, they're down 30. Building stocks are down 35. Banks, which you would think might be a symbol of credit or something else, are down 25%. The Russell 2000 is down over 20%. Retail equities are down over 20%. So how in the world could the S&P only be down 10 or 11 when I was looking at these numbers? It's because utilities, staples, and pharmaceuticals, which are economically defensive, are actually up. And this is the same situation I've used cycle after cycle. So that's one of the things, the inside of the stock market, which is the best economist I know and which I've used every cycle when I've invested, is saying there's something not right here.
And this is the same set of indicators that you've used to predict the past 4 recessions. The very same?
Yes, you might say it's because I have a not so pleasant personality, but at Duquesne, we did predict the last 4 recessions, and our returns going into them and as they started were always well above our average returns over time. So Inside the stock market is one indicator. The second would be the yield curve. Again, amber, not red. But we've inverted, as you know, from 5s and 2s, just slightly. 2 years are 269, 5 years are 268. The 10 years 285. So there's not only a big flattening going on, it's a very confusing bull flattening, because it's not like we're looking at high rates to start with here, and the Fed is, told us that there's going to be 3 to 4 hikes next year after this hike, and the market is just saying, no, no, no. Then the other thing we've looked at historically is credit. Tends to lead the economy. There seems to be a confidence that this cycle we don't have the danger we had in the last cycle, because the bad stuff, a la housing back then, has not infected the banks. It was more done in the high yield loan market. And to me, it's true. It's great that it's not in the banks, because that would probably be a systemic problem and financial crisis. But the economy doesn't really care whether credit is in the banks or it's in the investment community with high yield loans. In fact, I would argue that if you're on the other side of it, you'd much rather work your loan out with a bank than you would with some hedge fund manager out there. So the fact that, I'm sure you read the article in the Financial Times yesterday, and the fact that credit is drying up to the extent that it is, and there are all sorts of warning signs there. I think the GE CDS has gone from 50 basis points to 200 basis points since September 1st. IBM's gone from 30 to 80. High yield indexes are moving. Leveraged loans are down 3%. But more importantly, because we've had 8 years of free money and the kind of excesses and pushing people out in the yield curves that's created, it's just a time for caution that you want this bubble to unwind slowly now, because if you don't, and let's say these indicators turn red, you may have to do a lot more crazy monetary stuff, and actually it'll be more of a problem in terms of someone like me who eventually wants to normalize, wants to deleverage. That's the train I've been on, I understand. But this is in an effort to let that bubble out slowly. Someone, I believe, used the term 3 or 4 years ago that this is a beautiful deleveraging taking place. I have no idea what he was talking about. How do you have a beautiful deleveraging with U.S. debt going through the roof at the government level and corporate non-financial debt growing at the rate it was? So what I'm asking for now is not a cut, just to take stock of everything I've said and wait and see what happens. And what I'd really like to think, my business, as you know, is risk reward. So let's just talk about the risk reward here. Let's suppose I'm completely wrong, and 3 to 4 months from now, none of this stuff mattered. All the financial people were crazy and they were panicking because of some technical factor in the market. And let's suppose the Fed did not hike tomorrow. What is the cost? Okay. I'm not sure what the cost is, but there's got to be some cost to their credibility 2 to 3 months down the road when they start hiking again. Not a big cost, in my opinion. Let's suppose that these economic indicators, the stuff we're looking at, the forward-looking stuff, is right, and we have big potential problems brewing, and that they could be even bigger than we think, because there's stuff hiding out there we don't know about in terms of malinvestment. Think about the cost. If they hike tomorrow, and if they continue to shrink their balance sheet $50 billion a month, right when the ECB is not offsetting it, I mean, that cost to me is 5 to 10x.
You really believe that that 3-month period makes enough of a difference? In other words, by hiking on Wednesday, presuming that's what they're going to do, or hiking now in December instead of hiking in March, I think it's important that I understand how you're thinking. Is it because these that in and of itself could turn those flashing amber signals to red?
Well, the hike's already,
It's baked in.
a dovish hike is now baked into the market. By the way, the market doesn't seem to be very impressed with it as we sit here today. Confidence is a fragile and an important thing. I think the market is confused about a Fed that 3 or 4 months ago sort of let us know, well, we're going to continue to hike until something either starts to break or financial conditions tighten.
Because they're not sure how far they can go.
Yeah. And I remember when I was in my complaining period, as you call it, every time I'd talk, some in the audience would raise their hand and say, well, what would you do if you were at the Fed? Because I was complaining they weren't starting and then not going fast enough. And I would always say the same thing. I said I would sneak one in every time I could under booming financial conditions and hopefully get to 3%, and then you're there. I don't call hiking rates on top of shrinking your balance sheet $50 billion a month when the S&P just went down 13% and all the cyclical stocks we talked about are down somewhere between 25 and 40%. I don't call that sneaking one in when financial conditions permit it.
Those, though, who study the Fed and, like you, and maybe even consider themselves economists, would argue that 25 basis points isn't enough to make a difference to anything. And that if, in fact, the Fed is making a mistake, that mistake was baked in. And that whether it's December or March or perhaps even June doesn't make that much of a difference.
Well, it seems to be baking in at a very rapid rate, doesn't it? Again, it's not even the level, it's the rate of change. And I think if you look back historically, I could be wrong on this, we in the US have never hiked into a meltdown like this since Volcker. And he had a purpose and he had a goal. Inflation was 12%, and come hell or high water, he was going to break it. What exactly what are we solving for here? I don't quite get it. And I got it 3 or 4 months ago, but now it looks like the markets are warning. And again, Eric, I'm not suggesting the Fed cut. I'm really not, although who knows where my mindset will be in that 6 months. I'm just talking about not hiking rates. And by the way, we're sort of hiking rates. We're certainly tightening monetary conditions even if we don't hike tomorrow.
Because of the roll-off of the Fed's balance sheet.
Because of balance sheet. Now, some will say, well, it's just rolling off, they're not selling. That's not correct. If you have a budget deficit and you need to raise money every month, that creates government bonds selling every month and it tightens liquidity. It's not a surprise. I know no one looks at money supply anymore. I'm a dinosaur. But M2 growth has gone from about 7.5% to 4% over the last couple of years. It doesn't take a genius to figure out why. Liquidity is tightening, and it's tightening rapidly.
So just to be clear, you want the Fed to pause, wait 3 months, perhaps even wait 6 months, and then reevaluate. Is that right?
Yeah, it doesn't even have to be 3 months. What I would really like the Fed to do is get out of the forward guidance business completely. I don't know what it does other than tie their hands. I really believe the Fed would have tightened quicker on the upside, but if you'll remember, at the time, they guided after the temper tantrum to a specific schedule of QE rolling off, and then they guided that interest rates couldn't raise, and of course the economy and financial conditions were booming, but they didn't want to lose credibility, so they stuck to that schedule. What I would like them to do now, and of course they're not going to do it, but if I was running the Fed, I would say something like, we're pausing in terms of interest rates for now. We would like to normalize over time, but when you normalize matters. And I would say the same thing with the balance sheet. Our long-term goal is to get the balance sheet down, but over the near term and the intermediate term, we will be data dependent in the way we actually do that. You know, I grew up in a world where the Fed didn't spoon feed you every day. You just come in and turns out they've raised rates, or they're just tweaking the repo rate or something, and we seem to do fine without the spoon feeding.
You want them to go back to an era of best judgment.
Best judgment, and I want them to untie their hands. Forward guidance ties their hand. And to be frank, given their record, it's kind of embarrassing when you forward guide and then you're stuck with a guidance that is not necessarily appropriate. You know, you asked me earlier, what indicators am I seeing? Can I just say that the Fed, one of the things that's really puzzled me, the Fed's mandate, as you know, is maximize full employment over the longer term and stable inflation, stable price stability over the longer term. Okay, think about that as a mandate. To me, the way you achieve those objectives is you do not do it with boom-bust cycles. And we continue to do these boom-bust cycles. And one of the reasons is somehow the Fed has confused what we're solving for, which is price stability and maximum employment, with using employment as an indicator. Employment is in the lagging indicators. So just because you want to maximize employment doesn't mean when the unemployment is rate, is low, you can't back off. In fact, as you know, most recessions were preceded by a very low unemployment rate. That's where you do. You run out of capacity.
Stan, you know what the cynics are going to say, right? They might even be saying it now. That this has nothing to do with the economy, that you as an investor want the Fed to pause because you want a Powell put. Or worse, some of those people might say that you're just giving cover to President Trump.
Okay, on the Powell put, I just told you I have a demented personality, and I've been able to make more money in bear markets than bull markets. So I have struggled, as I've said in some other interviews, which I know you're aware of, since we went into the QE business and suppressed all this volatility. So at least going forward, this is the kind of environment where historically, if they continue to ignore the kind of signals I'm talking about, would provide a fruitful one. And I do want to address Trump.